Picture two people standing at the same starting line, each holding $20,000, each about to make a decision that will quietly shape the next 20 years of their financial life, and neither of them fully realizing how different those two paths actually are. Because on the surface, the choice between real estate and stocks looks like a simple matter of preference, when in reality, it is a choice between two entirely different systems of math, risk, and behavior that pull on a person in very different ways over time. The first person buys a rental property, and immediately something interesting happens because that $20,000 is no longer the full value of the asset. It is only the down payment, and the bank quietly supplies the rest, which means the property can grow in value while only a fraction of its price was ever actually paid for, a mechanism known as leverage. And leverage is what makes real estate feel powerful, since a modest rise in property value can translate into a much larger percentage gain on the original investment. Though this same leverage cuts both ways because a decline in value is similarly amplified. And unlike a stock, a house cannot simply be sold in seconds if things turn difficult. It comes with maintenance, tenants, vacancies, taxes, and the slow grinding reality of illiquidity. The second person puts that same $20,000 into a diversified stock portfolio, and here the math behaves differently because there is no bank standing behind the purchase, no leverage multiplying the outcome, just the raw performance of the market itself compounding quietly in the background. And historically, that compounding has produced strong long-term averages, though those averages hide significant volatility along the way, meaning the portfolio can lose a meaningful percentage of its value in a single year. Something a rental property rarely does on paper, even though the property is arguably just as risky. Its risk simply moves slower and hides behind the illusion of stability. What actually separates these two paths is not which one is mathematically superior in isolation, but how each interacts with a person's behavior, discipline, and access to capital. Because real estate rewards patience, tolerance for debt, and a willingness to manage a physical asset, while stocks reward consistency, emotional control during downturns, and the ability to leave money untouched for long stretches of time. Neither path guarantees an outcome, and neither should be viewed as a shortcut because both are simply different systems for turning time, risk, and behavior into long-term financial change. And understanding which system fits a person's temperament matters more than chasing whichever one appears to be winning this year.